Bismillahirrahmanirrahim. This is the first video on the use of funds in governmental accounting, and we are going to talk at length about what is fund accounting. We will talk about the elements of government financial statements. We will discuss measurement focus and basis of accounting. We will talk about governmental type funds, and finally we are going to record some transactions under different bases of accounting like cash basis of accounting, modified accrual basis of accounting, and accrual basis of accounting. While we will talk at length about proprietary type funds and fiduciary type funds in the videos to follow. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope that this video helps aspirants of CPA, AICPA, ACCA and CMA programs. We also hope that this video helps students of Masters in Financial Accounting, Masters in Taxation, Masters in Governmental Accounting, and students who have joined training courses of Saudi Organization for Certified Public Accountants, SOCBA, and other accounting program aspirants. We also hope that this video helps fresh graduates who have joined governmental or not-for-profit organization. So let us start with what is fund accounting. The main purpose of governmental reporting is accountability towards the users. These statements record the revenue generated and expenses incurred by the government in the various projects. In order to simplify the accounting information, each major project is identified as a fund. So consider each fund as a separate legal entity. So for each major project, a fund is created. A fund is a fiscal and accounting entity with a self-balancing sets of accounts. So each fund has its own accounts, its own chart of accounts, its own general journal, its own general ledger, and its own financial statements. So a fund is an entity within an entity. Recall that there are no owners in government, so the accountability is more important than in business. There are two main reasons to do this. Number one is accountability, and second is internal control to keep track of revenue and expenditure for each fund. So they want the financial statements to be simple so that users can understand it well. So if the government is building a school, then there must be a capital project fund for a school. The government will raise taxes to fund this project, and all the revenue generated and expenses incurred in building this school will be recorded in the capital project fund. The government may be having a major project on healthcare. So there must be a healthcare fund that will record all the revenue generated and expenses incurred to operate this project. Let us look into the governmental fund balance sheet for the city of Chicago and go deeper into these funds. So we have the city of Chicago balance sheet for governmental funds, and these funds are grouped into unrestricted funds and restricted funds. General fund is a unrestricted fund. As the term suggests, there are no restrictions in the use of these funds and are used for general operation. Then we have restricted funds, and these funds can be used for a specific purpose only. For example, a special revenue fund, there can be a special revenue fund for taxes on fast food, taxes on highway, for repair and construction of those highways. There can be a debt service fund, funds that the government will use to pay off the debt. There can be a capital project fund, a fund that the government will use for construction of roads, buildings, schools, etc. So government will not have just one special revenue fund or just one debt service fund or just one capital project fund. There may be several special revenue funds and there may be several capital project funds. Therefore, each fund will have its own set of financial statements, and the assets and liabilities for each fund will be recorded in these books. In the city of Chicago, the general funds, the restricted funds are, general fund is obviously the unrestricted fund, but then federal, state, and local grants, special taxing areas, or service concession and reserves, bond or note, bonds and note redemption and interest, debt service, community development, all these are restricted funds, and these funds can be used for specific purpose only. So next, let us talk about the elements of government financial statements, and there are 7 elements of financial statements for a government entity. 1 2 3 4 5 6 7, and of these 5 are related to the financial position, which is a balance sheet, and 2 are related to resource flows, and it is similar to the income statement. So let us look into each one of these elements, and first one is assets. Assets are the resources with present service capacity. For example, cash, supplies, receivables. So they are very similar to a business. Liabilities present obligations to sacrifice resources. So in order to provide services to the society, government will have obligations to be paid to the third parties. The third element is deferred outflow of resources, and you will not find this element in the financial statements of a business. I can show you again in the city of Chicago, so can see here we have deferred outflows, and deferred outflow of resources is the consumption of net assets applicable to future reporting period. For example, the government grant money to another entity to be spent in future period. So deferred outflow of resources is similar to a prepaid expense in the business. If you can recall, prepaid expense is the advance payment for goods or services to be received in future. So such payments are recorded as an asset but will be expensed when such goods or services are received. So in case of governmental accounting, prepaid expense is called deferred outflow of resources. For example, the province gives $1 million to the city as advance to be spent on construction of houses for poor old age people next year. The money received by the city is a prepaid expense, but in governmental accounting, we will call it deferred outflow of resources. The next element of government financial statement is deferred inflow of resources. And you won't be finding this element too in the financial statement of a business. Recall, I would go back to so we have deferred outflow of resources and we have the here we have the deferred outflow of resources. So deferred outflow was prepaid expense and deferred inflow is like unearned revenue in the case of a business. If you can recall that unearned revenue in the financial statement of business is the money received by the company for a service or product that has yet to be provided or delivered. So if you put this in the accounting equation, so cash has been received but the services or goods are not delivered, so this becomes a liability and this is unearned revenue as our liability. So the money received cannot be accounted as a revenue now, rather it has to be deferred for the future period, and unearned revenue is the prepayment for goods or services that a person or company is expected to supply to the purchaser later. In governmental accounting, unearned revenue is called deferred inflow of resources. So deferred inflow of resources is the acquisition of net assets applicable to a future reporting period. And the classic example is the taxes received in advance. So if your money is received in advance, then the business has created a liability and the journal entry would be cash is debit and unearned revenue is credit. Now this is in the case of a business. Unearned revenue is a liability as the business has received cash in advance before the goods or services are delivered by the business. However, when the government receives taxes in advance, cash is debit. So cash, because government is receiving cash, but the government has no liability to deliver any service or pay back the taxes to this particular taxpayer. And that's why we credit deferred inflow of resources. So advance taxes is not considered as a revenue. So deferred inflow of resources acts like a liability, but we don't call it a liability as the government is not liable to the taxpayer. To summarize, prepaid expense is an asset and is called deferred outflow of resources, and unearned revenue is a liability and is called deferred inflow of resources in governmental accounting. The next element of government financial statement is net position. The residual of all elements presented in a statement of financial position. So, assets plus deferred outflow, which is similar to assets, minus liabilities minus deferred inflows, which is similar to liabilities, is equal to net position. So assets plus deferred outflow, which is similar to assets, minus liabilities minus deferred inflow, which is similar to liabilities, is equal to net position. GASB statement number 63 require that governments, unlike businesses, must report deferred items in a separate category. So thus a statement of position might be assets plus deferred outflow of resources, this is similar to assets, I repeat, liabilities minus deferred inflow of resources, this is similar to liabilities, is equal to net position. So total assets minus total liabilities is equal to net position. So we record deferred outflow and inflow of resources separately because this is the GASB statement number 63 requirement, and they are not really assets or liabilities, but they act like assets and liabilities. In business, assets minus liabilities is equal to equity. In case of governmental accounting, assets minus liabilities is equal to net position. So the concept is the same. Also remember that net position is also called fund balance, and I will refer to it after some time. So these are the 5 elements, and they are called the financial position accounts: assets, liabilities, deferred outflow of resources, deferred inflow of resources, and the net position. The remaining 2 elements, outflow of resources and inflow of resources, are like income statement accounts. Outflow of resources is the consumption of net assets applicable to the reporting period, that is called expense in the business. For the time being, consider expenditure as an expense, although it is different from expense, and we will elaborate it later in this video. Inflow of resources is the acquisition of assets, that is called revenue in the business. So based on GASB statement number 63, fund accounting uses the equation as assets plus deferred outflow, this is similar to assets, is equal to liabilities plus deferred inflows plus fund balance. We can put it like this as well. In a slightly different form, assets plus deferred outflows minus liabilities minus deferred inflows is equal to fund balance. If you have gone through my previous videos on governmental accounting, by this time you may be knowing that the governments prepare two sets of financial statements, one on the basis of accrual basis and other on the basis of modified accrual basis. An important distinction is, let me show you again in the city of Chicago. So this is the financial statement, and this is prepared on a full accrual basis because this is the statement of net position. This is government wide. So the residual amount in this case is referred to as net position in statements that are prepared on a modified accrual basis. And in the modified, okay, here we have the balance sheet, and in the balance sheet for the city of Chicago, the governmental funds, assets minus liabilities is not called net position, but rather it is called fund balance. So you can note that both fund balance and net position are like owner's equity. They are the residuals, the difference between assets and deferred outflows and the claims against those assets, that is liabilities and deferred inflows. So you can notice that there can be several restricted funds, 1, 2, 3, 4, 5. There may be several restricted funds, but there is only one general fund. There is only one that is unrestricted. And when we look into the government fund balance sheet, it includes assets and liabilities that are current. You can see that we have only current assets, we have only current liabilities, and the difference is called fund balance. So let us talk more about fund balance, and we are going to talk about it in the next slide. So before we go, we can see here that fund balance is grouped into 5 different categories. We have non-spendable, we have restricted, we have committed, we have assigned, and we have unassigned. So this classification explains the nature of the funds, and these funds can be spendable or non-spendable. Gatsby statement number 54 states that fund balances of governmental types are now to be reported on a hierarchy in 5 different classifications. We have non-spendable, we have restricted, we have committed, we have assigned, and not, this is a mistake, this should be assigned and unassigned. Assigned and unassigned. So governmental funds can be spent under any of these 5 headings, and these 5 headings can be grouped into spendable or non-spendable. GASB statement number 54 states that only the fund balance reported on the balance sheet of governmental type fund is affected. It does not affect the reporting of net assets by proprietary or fiduciary funds. It does not affect the reporting of net assets or governmental activities in the government-wide financial statements. And we will talk about proprietary and fiduciary funds in later videos, but right now we are going to talk about fund balance identified between non-spendable and spendable resources. So non-spendable amounts that are not in spendable form, like supplies, inventories, or those that need to be maintained intact. For example, the government has a restricted investment. So they can use the interest for any purpose, but the investment is to be kept intact. They can use interest only if there is a restricted investment. The remaining fund balances are the spendable fund balances and are reported in these categories based on constraints. So restricted or committed or assigned or unassigned. They are going to be spendable fund balances and they are going to be reported in these categories based on constraints. So let us talk about each one of them, and the first spendable resource is restricted. So such funds are restricted by the providers of these funds either through a constitutional provision or enabling legislation. So they are spendable resources but restricted. It includes grants constrained to specific purposes by their providers or through constitutional provisions or by enabling legislations. Enabling legislation authorizes the government to assess or mandate payments of resources and includes a legally enforceable requirement that the resources be used only for the specific purpose. For example, a state allowing cities to collect on taxes on food and beverages for street maintenance. So all the taxes collected on food and beverages by the state can be spent on street maintenance, and this is the restriction. Or the restriction could be externally imposed, maybe by the creditor or bondholder, grant provider, contributor, or imposed by law through constitution or by enabling legislation. So restriction can be imposed by the legislation or by outside parties. So the government can collect the taxes, but they can spend only on street maintenance, as we have talked about just now. And the restricted funds cannot be used for any other purpose. Another spendable resource under the fund balance is committed. So let us talk about it. The constraints are imposed by a formal action of the government's highest level of decision-making authority. These funds cannot be used for any other purpose unless the government removes or changes the specified use by taking the same formal action that originally imposed the constraint. Committed funds include contractual obligations for which existing resources in the fund have been specifically committed for use. Note that in contrast to fund balance, that is restricted by enabling legislation, amounts in the committed fund balances can be redeployed for other purposes with appropriate due process. Since the funds are committed by the highest government authority, so the constraints are imposed by a formal action by the government at the highest level of decision making authority. So committed funds cannot be used for any other purpose unless the government who imposed restriction removes it. In the next slide, we will talk about the third spendable resource, and that is assigned. Government intends to use the funds for a specific purpose. Intent can be expressed by the governing body itself or another body that has the delegated authority. Fund balance in other governmental funds except general fund that is not restricted or committed is considered as assigned in those funds. In other words, it is the residual balance of these funds. Note that the authority for making an assigned fund balance need not to be made by the government's highest level of decision-making authority. Constraints imposed on assigned amounts can be more easily removed or modified than those that are classified or committed. In contrast to committed funds, assigned funds come from a lower authority and not the highest authority. The government intends to use it for a specific purpose. Intent can be expressed by the government body itself or another body that has a delegated authority. Fund balance and other governmental funds other than the general fund that is not restricted or committed is considered as assigned. And I would like to show you again the city of Chicago, and you can see that we have the assigned funds, and you can see that there is a general fund and we have other funds, and under the other funds, if something is not restricted or committed, then it is automatically becomes assigned. You can see over here. So it is just like by default, it is the residual balance. So the government will put all the remaining fund balances to assigned if it is not restricted or committed. So since the authority of making an assigned fund balance need not to be made by the government highest level of decision making authority, constraints imposed on assigned amounts can be more easily removed or modified than those that are classified as committed. Therefore, it is easier to change the assigned funds than the committed funds. In the next slide, we are going to talk about the fourth spendable resource, that is unassigned. The last balance that we are going to talk about is the unassigned fund balance. The unassigned is not restricted and it is the only residual classification of the general fund. Therefore, whatever is left is the unassigned. So, if the fund is not committed or not restricted or not a general fund, then it is a unassigned fund. It includes the amount that are available for any purpose. So the government can use it for any purpose. I would like to show you again something interesting. Uh, if you look into the unassigned fund balance, it is only the general fund that can we have the unassigned, and under the general fund you can see it is positive. It has a positive fund balance or positive unassigned fund balance, but for other governmental fund this category is used only as a negative fund balance. You can see here it has a negative fund balance. uh, Again, if you look over here, they have a negative fund balance. So next, let us look into the crosswalk for different types of government type funds and level of constraints imposed by GASB 54 statement. Notice that all the funds except the general fund cannot have a positive unassigned fund. You can also notice that these funds like special revenue fund, debt service fund, capital project fund, permanent fund have no positive unassigned. They have no positive unassigned. They could have negative because remember they could use a plug to make sure that assets equal liabilities plus fund balance. Now the special revenue fund could have a non-spendable. Definitely it could be restricted because it is a special revenue fund, and they could be committed to the fund balance and it could be assigned as well. The debt service fund, it could be non-spendable. Usually they don't, but they could be, and they definitely restricted because it is for the debt service, and definitely it could be committed and assigned. Capital project fund could be non-spendable, but definitely they are restricted and committed fund balances and are not assigned. For example, the government is building something and they want to have a fund for that project specifically. So this is an overview to explain restricted, committed, assigned, negative, unassigned, and positive assigned constraints. So these were the different constraints and these were the different governmental funds. And these are the constraints that are assigned by GASB 54, statement number 54. So it could be possible that any of those general fund is can have anything, they can be unrestricted, there is going to be only one general fund, and there will be many special revenue funds and capital project funds as they are. Next, we are going to talk about basis of governmental accounting. I am sure that by this time you have already gone through the basis of accounting for business in other accounting courses. Recall that business record revenue and expenses on full accrual basis, and the rule is revenue is recognized when earned and expenses are recognized when incurred. Yet another basis of accounting is called cash basis of accounting, and under cash basis of accounting it records revenue when cash is received and expenses are recorded when they are paid. We are not going to use the term expense in governmental accounting, rather we will use the term expenditure. Now, expenditure is the decrease in financial resources to settle liability with current financial resources, and we will talk about it in a while. So, full accrual basis and cash basis of accounting are the two extremes, and in between these two, there are other bases of accounting like taxation accounting or modified accrual basis of accounting. So, modified accrual basis is applied in recording governmental funds, and revenue is recognized when measurable and available to finance the expenditure of the current period. There are different type of revenues, and we will talk about them later in the other videos. Revenue is measurable, means that they can be expressed in terms of dollars. Revenue is available, means that they are accessible in 90 days. Notice the word expenditure appears under the cash basis and the modified accrual basis. We don't use the term expenditure in full accrual basis. Also remember that expenditure is not an expense, rather it is a decrease in a financial resource, usually cash, to settle a liability. The government has an obligation to pay for something, so a liability is settled by paying cash. Next, we are going to talk about measurement focus, that is, what are we measuring? So, what is measured? This means which assets and liabilities are to be recognized for recording. Next, where is the focus of an entity? Recall that each fund is treated like a separate legal entity. So, the entity is the fund, and the focus of the fund is economic resources, that is called economic resource measurement focus. So, the focus is on all the assets and liabilities, and it records all the long-term assets like building, equipment, etc., and all the long-term liabilities too. And the focus is to measure the operational accountability, how well the government has operated, including the long-term assets and long-term liabilities. So, the government is using the accrual basis of accounting when the focus is on economic resources. Yet another measurement focus of the government is on the current financial resources, called current financial resource measurement focus. And that means the focus is on current assets and current liabilities, while the long-term assets and liabilities are ignored. So, the financial resource focus on the inflow and outflow of current financial resources, and the current financial resources are cash or other items expected to be converted to cash in the current period. It measures the physical accountability, that is the legal and budget needs of the government. So, the current financial resource measurement focus is used by the government funds. I would like to talk a bit more on this regard. The government owns and controls roads, bridges, etc. So, they are the long-term assets, and the government will be held accountable in the light of the budget. In government organizations, the budget specifies how they will generate revenue. Remember, measurable and available, and how this money will be spent. Government has a fiscal accountability. That means it has to specify the revenue and expenses in the budget and then adhere to it. Fiscal accountability do not take into account the long-term assets and liabilities, as they don't tell anything as how the money came and how it was spent. So the government measures its activities using the current financial resources. So in cash basis of accounting, we record only cash. Modified accrual basis of accounting focuses on recognizing revenues when measurable and expenditure that are incurred. It focuses on short-term assets and short-term liabilities. In full accrual basis of accounting, we measure all assets and all liabilities. We will be focusing only on two of them, that is full accrual basis and modified accrual basis. Let us talk more about them with the help of an example. So governmental fund statements, the measurement focus is current financial resources and the basis of accounting is modified accrual basis. Don't forget that current financial resources means we only measure current assets and current liabilities. It also includes the deferred inflow and deferred outflow. We will talk about the government-wide statements that uses the accrual basis. We will also learn about the proprietary funds statement that is a part of the government. The measurement focus is economic resources and the basis of accounting is accrual. The last one is fiduciary fund statements and its measurement focus is economic resources and the basis of accounting is accrual. So the government funds use modified accrual basis as the focus is on current financial resources. Measurement focus is closely tied to the basis of accounting. Let us see how transactions are recorded on cash basis, modified accrual basis, and full accrual basis. So let us analyze the first transaction. A donor pledges 1 million, giving the organization a legally enforceable 90-day cash note for the full amount. So in case of cash basis, there is no entry because the government did not receive any cash. The donor has only pledged, and making a pledge is not a cash transaction. Let us look into the second transaction. The donor paid 300,000 of the amount pledged. So here they are paying, so cash is received, so cash is debit for 300,000 and pledge revenue is credit by 300,000. Then the organization purchased a building for 600,000, paying 120,000 and giving a 30-year mortgage note for the balance. The building has a 30-year useful life. When appropriate, the organization charges a full year depreciation in the period of acquisition. So under the cash basis, since the focus is only on cash and not on long-term assets, so building cannot be debit. So we are going to debit building expenditure. And not building expense, and we are going to debit it by 120,000 because this is the cash transaction in the whole transaction. So building expenditure is debit and cash will be credited by 120,000. At the end of the year, the government will close all the accounts and will be left with cash. Okay. Then let us look into number 4. It hired employee. By the end of the period, they have earned 4,000 in wages but has not yet been paid. So under cash basis, there is no cash transaction. So there is no entry and the fund balance will be so there will be no entry over here. Now they have received cash 300 and they have paid for the building 120. So the balance 180 is the fund balance under the cash basis. Now we are going to prepare the same transaction using the modified accrual basis. Remember that under modified accrual basis, we record transactions using the current financial resources, and current financial resources are current assets and current liabilities. So when the donor pledges 1 million, so a promise to pledge is a legal obligation to pay. So the obligation is enforceable and the government has a receivable, and this is for within 90 days. So that means this is a current asset. So pledge receivable is debit by 1 million and contribution revenue is credit by 1 million. Then the donor has paid 300,000, so cash is debit by 300,000 and pledge receivable revenue, or rather pledge receivable. Yeah, it will be pledge receivable. And this is also pledge receivable is credit by 300. Then in transaction number 3, we have again there is a building expenditure. Debit by 120 and cash is credit by 120. So you can see that if you look into the transaction number 2, transaction number 1 rather, I'm sorry, in transaction number 1 we did not make any entry under the cash basis, and in transaction number 2 you can see that we have a similar general entry, cash is debit and pledge is receivable in both. And when there is a current expenditure, so that is also recorded. So again the general entry under the cash basis and the modified accrual basis is the same. We go for the 4th one, and under the 4th one transaction, it had employees. By end of the period they have earned 400 in wages but has not yet been paid. So again, under the cash basis, we have not recorded it, but under the modified accrual basis, the government will pay this employee in the near future. So we have to record it. So, and this is a current liability. Wages expenditure and not expense will be debit by 4,000, and wages payable will be credited by 4,000. And we will record current liabilities as this is the modified accrual basis. The focus is on cash and current resources, that is current assets and current liabilities. Let us look into the income statement that is going to be prepared under the modified accrual basis. So we have a pledge revenue of 1 million. Then there was a building expenditure of 120,000. Then there was salary, or rather wages, rather we won't be saying wages, for 4,000 that has to be paid. So expenditure, wages expenditure. So these two expenditures will be subtracted and the fund balance will be 876,000. If we prepare the statement of net position, we have notes receivable for 700,000 because the pledge was for 1 million. Of this 300 we have received, so we have still a receivable of 700,000. So notes receivable is 700,000. Then we have paid cash. So we have paid 120, so the cash left with us is 180,000, that is cash, and we have not paid the wages, so there is a liability of 4,000. And again you can see that the fund balance is 876. Finally, using all economic resources, that means we are going to record both long-term and short-term assets and liabilities, and we are going to follow the full accrual basis. Under full accrual basis, pledge receivable will be debit by 1 million and notes receivable will be credited by not receivable but rather notes contribution revenue. Pledge receivable is debit and contribution revenue is credited by 1 million. Then we have received cash, so cash is debit by how much? 300, and notes receivable is credited by 300. Then we have the full accrual basis for the payment. We have purchase of building, so now building is debit by 600,000, cash is credited by 120,000, and notes receivable is credited by 480. In the last, the salary has not been paid, so this is now wages expense and not expenditure, 4,000, and wages payable is credited by 4,000. So in case of governmental fund statements, we are going to use modified, while for others, that is government-wide financial statements, proprietary fund statements, and fiduciary fund statements, we will use accrual basis of accounting. So let us summarize. In governmental funds, there is general fund and all the other funds are not general funds. They are going to be spendable but restricted. There are no long-term assets or long-term liabilities, as modified accrual basis of accounting is used that focuses on current assets and current liabilities, including the fund inflow and fund outflow. So in this video, you are just wetting your feet, and we are going to work a lot more on these transactions in the videos to follow. I have put all these transactions in the template too, in case you find it difficult to read my handwriting. So since the government uses modified accrual and full accrual basis of accounting only, so let us look into few more transactions and we will ignore the cash basis of accounting. Now the transactions reinforces the concept we have discussed so far. It explains how to account for transactions under the modified accrual basis and under the full accrual basis. And in the previous slide, we have seen that the transaction affect fund statements differently than they do government-wide financial statements. And now we are going to record the transactions in fund statement, and we will also record the same transactions in the government-wide financial statements. When we record in government-wide financial statements, we use the full accrual basis as we have done over here. We'll use the full accrual basis, and when we record in the government funds, we use the modified accrual basis. So let us see some more transactions. And in the first transaction, the government issued $20 million of bonds to purchase a new municipal official building. So when it is modified accrual basis, we have received cash. So cash is debit by 20 million, and this is other sources of revenue that is credited by 20 million. So the money is borrowed by issuing bond, and since the government has borrowed to purchase the building, so this will be recorded as capital project fund. Remember that under modified accrual basis, we record borrowings as revenue, which is a governmental fund. Under full accrual basis, cash will be debit and bonds payable is credit for 20 million. Then let us go to the second transaction and acquire the building for 20 million. Under the modified accrual basis, when government buy a building, they don't consider it as an asset. Rather, they consider it as an expenditure. So the government will record transactions like personal transaction. Like when I buy a jeans, I will not consider it as an asset. Rather, I will consider it as a expenditure. What I spent now is the resource measurable and available. So under modified, this will be building expenditure, debit, and cash is credit for 20 million. Under modified accrual basis, and under the full accrual basis, building will be debit and not building expenditure, and cash will be credit for 20 million. Let us look into the third transaction. Recognize and as appropriate 300,000 of depreciation on municipal vehicles. Now under modified accrual basis, we will not record this transaction. So there will be no entry, because under modified accrual basis we don't have long-term assets, and since there are no long-term assets, there will be no depreciation also. Under full accrual basis, yes, depreciation expense is debit and accumulated depreciation vehicle is credit for 300,000. So that's how we do transaction number 3 under modified accrual basis and full accrual basis. And now let us look into transaction number 4. Transfer 2,060,000 from the general fund to the debt service fund. Now don't forget that each fund is treated as a separate entity. So when there is a transfer of money between two funds, there will be two journal entries. One will be to take the money out from one fund, and second to add the money to the fund. So under modified accrual basis, the first transaction will be transfer out. Transfer out to debt fund, debit for 2,060,000, and cash is credit for 2,060,000. And the second will be to add the money to the bank. So now we are going to debt fund has received the money, debt service fund, they have received the money. So cash is debit by 2,060,000, and now transfer in and not out. Transfer in from general fund is credit for 2,060. Under the full accrual basis, at the end of the year, the two cash are going to cancel out, as there is a debit and there is a credit for the same amount, and we will be left with transfer out to debt fund, debit, and transfer in from general fund to 2,060,000. And then we are going to reverse this entry at the end of the month, year, and so nothing will appear on the government-wide financial statement. Let us look into the fifth transaction. Paid 60,000 interest and long term and repaid 2 million of principal amount. So under the modified accrual basis, interest expenditure is debit by 60,000, and expenditure or I just follow the same norm. Principal debt expenditure is going to be debit by 2 million and cash will be credit by 2,060,000. For full accrual basis, interest expense will be debit by 60,000 and bonds payable will be debit by 2 million and cash will be credited by 2,060,000. Let us see number 6. So sold for 5 million village land that has been acquired for 4 million. The proceeds were recorded in the general fund. So under modified accrual basis, remember that under fund accounting all payments are recorded as a expenditure. So we are paying for the here we are selling, so there is not an expenditure, rather we are receiving cash. So cash is debit by 5 million and proceeds from sales is credited by 5 million. And under the full accrual basis, cash is debit by 5 million and land is credited by 4 million and gain on sale is credited by 1 million. As under the government wide, we are going to record the long term asset and we record the long term liabilities as well. So we can see that the modified accrual basis has a different objective than the full accrual basis. The government wide shows the big picture. It shows all the assets including long term and short term. The focus is on all the assets. Under the modified accrual basis, the focus is only on the short term assets and short term liabilities. As in case of governmental funds, the purpose is accountability. So modified accrual basis deals with budgetary compliance. So we have looked at short term assets, short term liabilities, money in, money out throughout the year for a specific purpose. For accrual, we are looking at the whole picture, at the whole government-wide financial statement. I have put this again in a template in case you have find my difficulty in reading my handwriting, and this completes the first part on the use of fund in governmental accounting. In the videos to follow, we are going to cover governmental activities, proprietary type activities, fiduciary activities, and I hope you have enjoyed this presentation. And if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or send me an email and inshallah I will reply you back. Thank you so much and happy learning.